Hi, my name is Quentin Chambers. I'm a financial planner and I hold the Chartered Investment Manager designation. My goal with these videos is to provide you with some educational content. Hopefully, it'll leave you living a happier, healthier, and wealthier life. So let's dive into it. This video is going to be all about if your portfolio is outdated and what you can do. Now, if you don't have a regular process for reviewing it, this may cause you to be paying higher fees, have poor diversification, have missed tax saving opportunities, and ultimately your investment portfolio might not be aligned with your goals. If you haven't looked at your investment holdings in a while, this video will help make sure you understand what's going on and how you can make sure that they're aligned with your financial goals. Now, I want to start with a successful investment portfolio starts with your goals and then it optimizes for performance and peace of mind. So let's start with the first thing, which is the elephant in the room, the set it and forget it syndrome. Now, if you're like many people, you live a busy life, you think about your finances kind of on a secondary order of things. You don't really think about managing your investments on a day-to-day. Now, I'm not asking you to become Warren Buffett here, but what I would like is for you to have a systematic process to review your investments to make sure that they stay updated. The reason why it's important to make sure your portfolio is updated regularly is because life changes, the markets change, and your financial goals change. Now, here are some signs to spot if your investment portfolio is outdated. First and foremost, you haven't revisited things in years. You own investments that you don't recognize, like old mutual funds, legacy stocks, or something recommended by a friend or former advisor. You don't know how much you're paying in terms of fees and transaction costs. Ultimately, what this means is if you haven't reviewed your portfolio in the last 12 to 18 months, it's time for a checkup. Step 2 is all about determining if your asset allocation matches your risk tolerance. Now, there's a lot of jargon in there, but putting it simply, your asset mix is what makes up your investment portfolio. So those are the stocks, bonds, and any alternative assets or investments that you hold. Also going to be the biggest factor that influences the amount of risk that you're going to experience through your investments, as well as your investment returns. Now, when we're talking about risk tolerance, that is your ability to both psychologically and financially bear any risk. So you can think about risk in a few different ways. Risk on one end is your ability over the short term not being able to stand, a major financial hit. Let's just say the markets go down and you need to use that money, or over the long term, not being able to reach your goals. So when you're thinking about your investment portfolio, here's some key questions to ask. Do you have a reasonable expectation of what your portfolio should return on an annual basis? Does this return match with what you need to achieve your goals? Do you understand how your portfolio or the underlying strategy did during periods of serious market turbulence, or even during the last few crashes? And last, given all that information, are you going to be able to stay the course both psychologically and financially during a seriously negative market? So to reiterate, your asset mix is a combination of stocks, bonds, and any alternatives that you hold within your investment portfolio, and that is ultimately going to dictate your risk level and your investment outcome. This mix should be aligned with your current goals and your appropriate risk tolerance. Now, a common example I see is when clients have accumulated more assets over time and they don't necessarily need to take on the same amount of risk that they did before to reach their respective goals. In this particular case, it may be worthwhile for them to shift to a more balanced or even a conservative strategy. So another element of risk is where your portfolio is looking for opportunities in the market. Now, what that normally translates to is over-concentration. Overexposure or over-concentration happens when your portfolio is looking for opportunities in particular segments of the market. So examples would be investing in specific companies like Nvidia or Tesla or whatever trending stock of the day. And you can even go more broad than that by having your holdings concentrated in specific countries like Canada, the United States, or whatever else. The issue here is that over-concentration ultimately leads to increased risk in the case that these sectors, companies, or countries go through a period of serious underperformance or worse, years of negative returns. So the yin to the yang of concentration is diversification. So the question you need to be asking is, are you properly diversified? Diversification is a commonly used term when it comes to investing. You often hear sayings like, don't stick all your eggs in one basket. However, diversification doesn't mean just holding 12 companies and then thinking everything's going to be fine. A well-balanced or diversified portfolio holds a mix of securities across companies, sectors, and countries, or even asset classes like stocks, bonds, or alternative investments, depending on your goals and your ability to tolerate risk. That's why being clear on your goals as a first step is so important, because then you can determine if you're taking on too much risk or not enough. Then ultimately with that, you pair that with a process that ensures your investment holdings are tied with your respective goals. Okay, we're gonna move on to the third step, which is identifying any high fee or underperforming investments. Now in Canada, fees haven't been properly required to be disclosed until regulatory initiatives like CRM2. Now there are many institutions that still offer what are called embedded fees, or in other words, fees that are charged to you as a consumer but aren't clearly disclosed. Many investors don't even know how much they're being charged. In addition to this, a common trend is for portfolios to hold legacy investments investments or securities that have been underperforming and charged relatively high fees. So here are some common issues when it comes down to performance. So normally the focus on gross returns, meaning what your portfolio actually kicks out for you. I think it's more important to focus on net returns, and that means how much you actually take away. This net return is influenced by factors like where you hold your investments. So when we're talking about tax efficiency, it's all about understanding where your investments are held with respect to these different accounts. You can put in an RSP, a TFSA, or a non-registered account, and all of those accounts will have different tax treatments. Again, RSPs are tax deferred, TFSAs are tax free, and non-registered are fully taxable. In addition to this, different investments like stocks, bonds, or real estate will also have different types of returns and therefore will have a different tax impact. Okay, so the next one is hidden advisory fees. This problem is obviously close to my heart and is not often explained well, but is extremely important to understand. When you're working with an advisor, there's a chance that you have what are called layer fees. So that's the advisor fees and then the portfolio or underlying strategies fee. And that's why it's so important to work with an advisor that specifically discloses these things so that you understand the cost and the value of their services as well as any underlying strategies that they use. Now, when it comes down to performance, the promise of market beating returns can lure you in, because who doesn't want to be better than average? Now, in contrast to this, an investment philosophy that's growing popularity is low-cost, index-based investing. This is where you buy an index-based product that tracks the market, which is inherently diversified. And because the goal with this product is to replicate a particular market, for an example, the S&P 500, it's inherently low cost because it's not actively trading to try to beat the market. The difference between low-cost indexing and high-fee active comes down to performance and fees. Now, the premise is when you're paying a high-fee active manager, they're going to beat the market, and therefore the fees that they charge are commensurate. But in reality, when you look at reports like the Spiva report, it shows that on average, these managers aren't able to beat the market, and therefore you're charging higher fees for this underperformance. So by reducing fees and moving closer to market average, you can save and earn potentially thousands, if not hundreds of thousands of dollars over time. Okay, so we're gonna jump into step 4, which is aligning your goals with your underlying investment holdings. Now, obviously, aligning your goals with your respective investment holdings has been a consistent point throughout this video. That's because as an investor, you usually have predefined investment horizons, which means you're gonna eventually use the money for something. Examples are major purchases, retirement, or even for your legacy. So that means accumulation for the sake of accumulation is rarely the goal. That's why being thoughtful about how much risk you're taking and the time that it's going to take you to achieve your goals is so important. In addition to this, it may sound obvious, your portfolio should reflect where you are today, not where you were last year or when you first started investing. Throughout your investing journey, it's important to consistently ask yourself, are you trying to achieve growth, income, or just trying to simply preserve your capital? It's also important to ask, do you need money for upcoming liquidity events, like retirement income, again, a major purchase, or trying to do early legacy gifts? Remember, investing is inherently an iterative process. As your goals change, as your needs change, as the markets change, your portfolio should also change over time. Now we're going to talk about step 5, which is to consider moving to a more disciplined investment strategy. Now, after all of this, if you're looking at your investment portfolio and you see it as a collection of random stocks or funds that are high fee and underperforming, or provided as a recommendation for someone you're no longer working with, it's probably a good time to transition to a structured, evidence-based investing strategy. Evidence-based simply means that it comes from reliable information that's normally peer-reviewed and academically sourced. An example of a popular strategy is the index-based investing that I formerly talked about. This can provide growth at a fraction of the cost. In addition to this, you can consider a factor-based strategy that tilts your portfolio to small cap, value, high profitability companies that have historically outperformed the market over time. Or depending on what stage of life you're in, you could also use a dividend or income strategy, especially if you're shifting towards retirement and generating cash flow as a priority. Now, it goes without saying, before you go make any changes to your investment portfolio, check with your investment advisor and your tax advisor to make sure you understand any potential impacts. Okay, so we've done a lot so far. So now we're going to talk about consolidating and simplifying for better oversight. Now, if you're like many investors, you've opened multiple investment accounts across multiple institutions, across multiple advisors, across multiple platforms. The obvious drawdown here is having too many accounts makes it harder to manage your money effectively. Consolidating your RSPs, TFSA, and non-registered accounts in one place can potentially reduce fees and increase oversight. In addition to this, a unified investment strategy can help push closer towards your goals. Ultimately, simplification leads to better control, fewer statements, and easy rebalancing over time. Okay, with that, it's the last step, and that's to consider working with or switching to an advisor that puts all of these previous steps into practice. This type of advisor can help you with the delegation of major financial decision making. They can help you with portfolio rebalancing and fee reduction. They can help you implement tax efficient strategies. They can reduce unnecessary risk and increase diversification, and ultimately make sure that your investments are aligned with your long-term goals. Now, I want to be clear here. It's important that when you're working with an advisor, their value goes beyond just managing your investment portfolio, as that is only one piece of your overall financial needs. Okay, with the DIYers out there, I want to leave you with one little note. As investors, we have access to low-cost, diversified investment products that are easily accessible through a discount brokerage or trading platform. Unfortunately, when self-managed, you may lose track of your long-term goals in the pursuit of performance. And if you don't pair your investment holdings with a structured or disciplined investment strategy, you may be taking on two types of risk. Risk within your portfolio and risk that you may not achieve your goals over the long term. Investment management isn't just about picking the right stocks or funds. It's about creating a consistent, reliable, and well-structured vehicle that will help drive to your goals over time. Remember, whether you're a DIYer or working with an advisor, at minimum, you should have a review process of semi-annually, if not annually, to make sure you're not leaving money on the table. Now, if this video was helpful, hit that like button, subscribe, and if you have any questions, drop a comment, as I'd be happy to hear from you. Till the next one, take care.